Ark Invest came out of nowhere a couple of years ago with a wild prediction that Tesla would become the best investment in the world. Now, this was back when it was trading for a measly $30 a share, and as Tesla soared, as the company grew traction and became the darling love child of every young investor online, Cathie Wood and her firm, Ark Invest, became the most hyped up fund manager in the world. She saw huge amounts of success as the pandemic hit the world, and she bet on stay-at-home stocks. Companies like Zoom and Peloton that were sure to do well as the world was locked down, and they did do well, fantastically well, as did Cathie. She outperformed pretty much every fund in the world during 2020, but as 2021 came and went, the magic disappeared. The monetary environment changed, and Cathie's favorite companies changed with it. Peloton went from being an innovative, daring tech company bringing gyms to people's living rooms, and now it's fallen down a pit of despair after being exposed as a company that simply glues iPads onto stationary bikes. As we see inflation continue to soar, the only question that really matters right now is by how much will interest rates rise? The tide has changed. Rate hikes are on the way, and when they come, they will change the capital environment all over the world. Companies that have built their brand off of huge projected growth long into the future will see their performances struggle, their projections will be missed, and their valuations will decline. Cathie's Ark Invest is made up almost entirely of these types of companies, and it is already clear which direction the ship is going. Cathie's Ark is sinking, and today we're going to uncover why. But first, make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. It is now February, so if you've been waiting to join, now is the perfect time.
We think that that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time. These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, TheGlobe.com, Go.com, Flues.com, DrCoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. DrCoop, for example, averaged 1.4 million monthly average users, or the equivalent thereof. And it went public in June of '99 and was out of business in December of '01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that.
So Cathie's views are clear. The innovation is here and it's here to stay. But the real issue here is that no one is denying that we're in an age of great innovation. No one is claiming that Zoom transformed the workplace and allowed billions of people to work from home for the first time ever. And no one is claiming that Teladoc hasn't done the same thing to the medical industry and completely revolutionized it. What people are claiming, though, is that a lot of these companies that are being priced based on the growth that they are hoping to see into the future are overvalued regardless of how innovative they are. Take a look at one of Cathie's favorite stocks, one of the companies that she has plowed money into for over a year now, DocuSign. It's an incredibly innovative company that has actually changed the way business is run all over the world. It's based around the idea that digital paperwork, contracts, deeds, and whatever else we find ourselves signing day in and day out is just easier, more efficient, and quicker online than it is on paper. It's easier to store documents this way, it's quicker to get them from one person to another. I personally have used software just like this. The other week, I handed over a rental property I own to a new property manager, and within 10 minutes, I had signed all necessary paperwork and sent it back to them without ever having to pick up a pen or even meet someone. This is, without a doubt, an innovative company that has changed the way we work, but that doesn't necessarily mean that its business is worth 50 times its gross annual sales. The real problem here with DocuSign is that it has no moat. It's a pretty basic software company that has no real comparable advantage over its competitors. I would know because I've also used their competitors. Signable, PandaDoc, HelloSign. There are literally 100 other companies out there that provide a near identical experience to the point that I literally do not even have the slightest preference as to which one I use. These competitors are all biting at the heels of DocuSign, and DocuSign has managed to pick up a really dominant market position, but that position doesn't mean anything when the company is losing money with every sale it makes. DocuSign generated $1.4 billion in revenue last year, 40% more than the year before, but there is no path to long-term profitability of the scale needed to justify what is now a $25 billion valuation, but what used to be a $70 billion valuation. Are DocuSign supposed to raise their prices to generate more revenue and to become cash flow positive? Guess what will happen if they do that? People will leave. They'll go to one of the 100 other identical services that don't raise their prices. And what happens when the big boys come to play? What happens when Microsoft starts to push people to use their native software that they can run at a loss for 100 years without even flinching because they just have so much cash? And what happens when Apple does the same thing? What happens when Apple automatically downloads this software onto your iPhone without you even knowing? DocuSign has no moat. They have no ability to ensure that customers stay with them long term, and it doesn't matter how much they've changed the world. It doesn't matter how much they're going to change the world either. A business has one purpose, and that is to make money, something which DocuSign is never going to be good enough at to justify its ridiculous valuation. Now, the markets are on fire right now. The S&P is having its worst month since March 2020, and analyst predictions are, to put it mildly, grim. 9 out of 11 of the S&P 500 sectors have fallen due to massive market sell-offs, and with the current uncertainty surrounding the Fed's decision to hike interest rates, buying the dip seems like it might not be wise. Now, I, for one, don't want the Fed to determine my destiny, and in my search for uncorrelated investments with strong risk-return features, I discovered an asset class that almost no one is talking about: art. Now, art has outperformed the S&P by 164% from 1995 to 2021, while showing low correlation to any major asset class. On top of that, it's proven to outperform during times of inflation. In fact, when inflation was equal to or higher than 3%, like it is right now, contemporary art's real return was 23%, whereas the S&P's return during that same period was simply 3%. Now, thanks to Masterworks.io, this video's sponsor, investors like me and you can gain access to this market. Masterworks.io buy million-dollar paintings by famous artists like Picasso, Warhol, or Basquiat. And here's how they do it. They leverage data to understand artist markets and trends within the asset class. After identifying attractive opportunities in the market, Masterworks.io acquires multi-million-dollar paintings with their own capital. Then they file the painting as a public offering with the SEC, which allows them to securitize the painting. Getting started with Masterworks.io is super easy. You visit their website, create an account, browse their artwork, so use the link in the description to gain priority access and invest in a Picasso today. Now, this is the big problem I have with what Cathie is saying. All that really matters in the long term is profitability, and innovation doesn't always drive profitability. IBM has been generating and securing more patents for new technology than any other company in the world for the last 3 decades, and yet it has been flailing as its competitors fly off into the sunset. Cathie is right when she said that companies back in the dot-com bubble were being valued merely on how many clicks and views they were getting. She is right that it was a bubble back then based on nothing more than delusions of grandeur and the hope that at some point in the future those eyeballs would be able to become revenues. The problem is, Cathie fails to realize that her obsession with users and revenues today is almost perfectly comparable. Sales in the billions of dollars don't matter unless there is a concrete path to profitability, and most of the companies that Cathie is betting big on have simply pushed that part of their business to the back of their minds, having convinced themselves that all they have to do right now is get users onto their platforms and cash to start flowing, and the earnings will come later. Now, the other major problem and the other major reason that Cathie's Ark is filling up with water is that the world is changing. Inflation is here, and despite what Cathie has preached for the last 18 months now, it isn't disappearing. Interest rates are going to rise, bond yields are going to rise, and the fortunes of every company in the world that is failing to make a profit today but is hoping to grow into that position in the future, they're about to change. Now, Cathie doesn't even try to deny this, because to be perfectly honest, it's not really feasible to deny this. These companies that Cathie loves, they all need to grow long into the future. They need to maintain growth levels of 50% a year or even higher, or they just have no chance of ever justifying their valuations. Most of these companies aren't even generating a profit yet either. They are burning cash, and what this means is that they have to raise capital. They have to take out loans, they have to release bonds, they have to release new shares, and this will all get more expensive as we move into the future. Interest on debt will get more expensive, yields on bonds will get higher, and investors will want better deals on their investments. It is going to get more and more expensive for these companies to continue to grow, and that means taking out less capital, investing less in future growth, and less growth for years into the future. This is why Ark has been getting hammered. This is why Cathie's ship is sinking, because the market has become adamant that the capital environment is going to change, and when it does, Cathie's stock picks are going to struggle. Now, Cathie does have a convenient way of ignoring this problem, but I'll let her tell you herself.
What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of boning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. Then we get to autos. I think this is the most fascinating part of what's going on in the economy right now. The Manheim Used Car Index has been screaming. I think the prices of used cars at their peak had increased on a year-over-year basis something like 60%. And that was adding to the CPI. Well, very interestingly, we've had a few reports now that suggest that the bubble was in used cars and that it might be bursting. We can see this a few ways. On a year-over-year basis now, used car sales units are falling. They're down 4%. November to December, they were flat, but year-over-year, that was down 4%. We're seeing prices finally start to fall. They were down 1.2% month to month. Again, annual, that's a big decrease month to month. Annualized, roughly 12%. On a year-over-year basis, they're still up 46%, but they have started to fall.
So Cathie doesn't think that interest rates rising and capital markets changing is an issue because it simply isn't going to happen. Interest rates aren't going to rise because inflation is going to fall all on its own. Now, Cathie has some reasons to believe this, and she does have a couple valid points here, and it's impossible for anyone to say exactly what will happen in the future. Yes, used car prices are sky high, and yes, they are going to fall in the future as supply chain crises get worked out. Yes, shipping costs and shipping times are at all-time highs, and yes, these will both reduce in the future as supply-side shocks get worked out. Yes, microchip manufacturing is far below demand requirements, and that is leading to higher prices and fewer products. And yes, that is a problem that will be solved in the future. But the really big problem here is when these problems are going to be solved. And on this, Cathie's history is actually working against her. For months now, she's been telling us that we are past the peak when it comes to inflation, that we are on the way down now. She told us that used car prices are about to become deflationary and drag the CPI down, but they're still sky high, and according to pretty much every car manufacturer in the world, production isn't going to ramp up for at least another year or two. Cathie told us that shipping delays were on the brink of being solved, that soon there would be no more pile-up of ships sitting next to LA. But the problem is still present, it's just been hidden as those same delayed ships have been forced to anchor beyond the horizon so that no one can see them. Cathie told us that oil prices would never again rise above $70 a barrel, but here we stand today with oil sitting at $90 a barrel. Cathie has been claiming that inflation is transitory for far too long now, and the data has proven her wrong for far too long as well. Whereas the Federal Reserve and every other investor or economist has learnt their lesson and stopped peddling this toxic word that they seem to think removes any blame that was to be had, Cathie has not. She is still here telling us that it's all transitory and that it doesn't matter. The simple fact here though is that Ark K, Cathie's flagship fund, is down over 50%. Ark W is down 49%. Ark G is down 55%. SARK, a new ETF that was made literally just to short Cathie Wood's picks, is one of the best performing assets since its inception, returning 45% to its investors in just under 3 months. Investors have been fleeing her funds at a pace that you wouldn't believe. Just under a year ago, Ark K had assets under management of almost $28 billion, but today that number is sitting just above $11 billion. To put it very simply, Cathie's Ark is sinking. Now, if you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. It is now February, so if you've been waiting to join, now is the perfect time. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.